Welcome to the Nest Edge, where we, the advisors at Nest Financial, share our views and opinions about the markets and the economy. We name this the Nest Edge because we have a unique way of looking at data that gives us an edge over the choppiness over markets and the many, many various news cycles. What we discuss here is not investment advice, but rather education for you to make informed decisions. And if you know anyone or if you yourself are interested in seeking investment advice or having a glance at your portfolio, we would, please feel free to drop us a line at info@nestfinancial.net and we'll be glad to set up a one-on-one. Throughout this webinar, if you do have any questions, please feel free to pop them in the chat box and we will get to them in a bit. So now let's get to the fun stuff.
Fun stuff!
Woo! So here with me, I have our portfolio manager, Sean McDougall. He writes the insightful newsletters that hit your inboxes every month towards the beginning of the month. But before we get into that, I wanted to touch on a couple hot topics, or I guess buzzing topics. One thing is around Facebook, the largest social media, probably advertising as well, platform in the world, experienced a huge drop in their price, roughly about $100 per share last week, which equates to about erasing nearly $250 billion of market value. So, Sean, as a portfolio manager, what do you say about that?
I'm glad we weren't long Facebook. 25% in a single day. It's hard to come back from that. It's going to take if you're down 25, you're going to be back up. Let's call it around 30 to break even. That's immediately where my mind goes, is how to get out of that hole. The more kind of telling story is it hasn't popped right back. It's still had a slow kind of burn off. And that tells me there's not, the Facebook bulls weren't coming in right behind buying things when, the whole cheap argument didn't really play out. It has Wall Street spooked. There are some serious concerns. And we'll see how it plays out. I will say this kind of does feed into this whole quad 4 thing. This is usually when you see crazy stuff like this. I was not on that earnings call, so I did not hear it. But listening to our analysts who were sitting in on that, their review of it they said it was just shocking. Some of the things that were coming out of their mouths, because generally executives are super not transparent on earnings calls. They're saying a lot of words, but not actually saying anything. And they were being pretty honest, pretty open about what their future is, which is they're pretty much going into, which may turn out to be the right call. We don't know. Full bore into this whole metaverse thing. That is where they see their future. And there was a lot of, advertising slow, which is what you see in quad 4. And, different factors really hitting their bottom line. Right off the top with Apple changing their app settings, it's going to cost them $10 billion a year because they can't steal all your information without you knowing about it. Surprise, surprise. The real money with tech is them stealing all your information without knowing about it. So interesting, scary, and super fortunate. We were not long Facebook because I'm sure in the last year we've owned Facebook at some point.
Sure. And also we often discuss about how a concentrated position is typically not a good move. And it's important to diversify. So seeing this huge drop in Facebook kind of shows that, you can lose a substantial amount of money in a day.
Yeah. 25 is pretty, for a large company like that, that's shocking.
Yeah. 25%.
Mm-hmm. Yeah.
And so, another topic that's been buzzing is the high likelihood of the Fed raising interest rates. and maybe more than once, possibly this year. So I know, Sean, you'll probably get into that when you discuss the newsletter. So I'll also mention in this newsletter, you focused a lot on Quad 4. And so for those who are not familiar with, our Sean's investment process and what Quad 4 is, or if you didn't read the newsletter, Sean, can you share a bit about, what Quad 4 is and why it even matters?
Yep. So if you're a client and you're on this call, you know this, so ignore this, what I'm about to say, or listen if you want a refresher. There's 4 different possible scenarios of where we are from an economic outlook, where we are, where we're going, quad 1, 2, 3, 4. And it has to, depending whether growth and inflation are accelerating or decelerating. That's when you get those 4 outcomes. How deep you go into those quads matters, but the more important thing, which way are we and which way are we going, and what rate. But quad 4 is, you can kind of view it as top left quadrant is 1, top right. I guess my cameras are screwed up, so how to do this? Okay, doesn't matter. Just imagine this in your head, because I'm not this creative enough in front of a camera, because everything you're seeing is flipped. Top left is quad 1, top right is quad 2, bottom right is quad 3, bottom left is quad 4. It's the bad one. That's when growth and inflation are slowing at the same time. And we knew we knew Q2 of 22 was going to be a quad 4. It's as of this morning, like an 86% chance that's going to happen. Quad 1 was the knife's edge. We didn't know for sure whether that was going to be quad 1 or quad 4. That's, growth is slowing for sure. It's just inflation we were a little unsure about. It's that was on the knife's edge. So it looks as if right now we are in a very slight quad 1 or quad 4. Like I said in the little article, quad 4 is just generally not good for equities. There are certain ones that do better than others. Staples, utilities, REITs, sometimes healthcare. And that's just because, just because something back tests well does not mean it's going to work every time. You have to see what the signal is telling you. That's a fancy word for how the market is treating that position. That time, everything is, there's some things that rhyme and echo through history, but I really, 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 really hate my peers that just say, well, in fall of 1987, so-and-so happened, so clearly this is going to happen again. It's garbage. It's a complete joke. There are similarities, similar sets, fractal math that are similar. But to say that it's like, if anything, this reminds me of, fall of 2018, the kind of the setup with treasuries. But outside of that, we'll see. The only equities that we're currently long domestically is consumer staples.
So, Sean, in regards to the Fed raising interest rates, will that impact portfolios? Like, are we ready for that to possibly happen?
Yeah, that's the only thing I'm worried about in all of this nonsense is the Fed is being the Fed again. And it reminds me, again, so much of September, October, November of 2018. For those who don't think about these time series as like I do, that was almost the exact same damn thing that we were doing now. We were coming off of, a peak cycles, and we were rolling into a slowdown, which is what we're doing now. And the Fed is backward looking and seeing in all these hot numbers, the inflation that was transitory, which wasn't. And they're going to start doing rate hikes into that. That is a double-edged sword that just tears you in half. We're slowing already, and then the Fed raises rates into that. I think the Fed's futures, it's like 5 or 6 rate increases. One is going to happen. My hunch is one's going to happen, and then the market is going to freak out, and then the Fed's going to pause, and because whatever the market does, the Fed just kind of listens. If they did 2, we're like shit could go sideways. If we did 3, the world could blow up. They need to be very, very careful about tightening into this slowdown, because these are the type of mistakes that really can get out of hand fast. It's what happened at the end of 2018. It's why we had the worst December in the history of Decembers, is they tightened into a slowdown. These, academic types that, have never traded in real markets. They live in their little ivory towers and like to bend economic reality, or they think they have the power to. Would be a massive mistake if they did for sure 2 and for damn sure 3 rate increases.
So in case, with the expectation that interest rates will rise, it'll be more expensive to borrow in general.
Sort of.
Are our
Yeah.
portfolios, that many clients are invested, are we set up for that? Are we
Yeah,
ready?
we're positioned for rising growth and inflation. And in those environments is usually when you see these kind of stupid behaviors. And yeah, if the Fed, selfishly for Nest clients, the Fed being idiots would be great for us. Like, do 7 rate hikes. We're going to see the world melt around us, but like our models are going to do great because we're positioned for that. Now, we'll see. My hunch is they're going to do 1 and then get cold feet. Powell's going to get, his buddies are going to be calling him, say, stop that crap. You're smoking us over here. We'll see. I don't care. I care what they're doing, but I don't adjust to guess what they are trying to do. I care more about the macro. What's the data saying? Where are we? Where are we going? I don't fight the Fed. I front run the Fed because I could see the data that's coming to them months in advance. Now that I'm sure they look at it. They just don't act on it. They like to sit, wait. Janet Yellen was the favorite one. She likes to measure, map, confirm, measure, map. It's like, Jesus, the numbers aren't changing. I mean, but that's a long-winded way to say, yes, the models are ready for that. I hope it doesn't happen to the severity for just the world. But I don't have any faith in the Fed doing what's best for anyone but themselves.
Well, I don't want the world to melt down.
No.
But I'm happy that we are positioned in a way that in case things do go sideways,
we'll be fine. Yeah,
we'll be prepared.
Yeah.
So,
quad 4s, we are, if there's one thing that we're good at is calling out, sniffing out, and positioning for quad 4s. Again, we had one in 2018, we had one in 2020, and we're going to have another one here. How severe it is, I don't know. And it
fared out well for clients too. I mean,
we were fine.
So yeah.
The timing of transitioning out of quad 4, once we start seeing some, topping and bottoming are not single points in time. They're processes. So you could start to say, okay, we're making a series of, things have seemed to have bottomed. The data is accelerating the opposite direction so we can hop back on in the other direction. So I think we're positioned. I know we're positioned perfectly for what we anticipate happening the rest of the year. It's just going to be time and space. We're already there. We're already positioned. We're just waiting for the treasury market really to catch up to us.
Sean, how long do you think we'll be in quad 4? I know your crystal ball is still in the shop, so you can't give us an exact
I don't know.
But what are you thinking? When will you possibly see another quad or a shift in quads?
So it is, the 86% chance that we have a quad 4 in Q2 of this year. So on paper, we're in quad 4 through June. Now, that means in, Q3 of this year, we will be in a different quad. Now, so what that means is the signal will generally start pricing in a quad shift in May or early June. So it's really paying attention to when the data starts spinning the other direction and transitioning from quads. When there's a quad shift coming next quarter, usually there's a few weeks in advance you start to see that. That's exactly what we saw at the end of 2021. Everything was smooth, hunky-dory until around November. And the market started pricing in a regime change of quads. And that's exactly what we saw on the screws. The signal pulled forward all those expectations. So, markets are extreme, don't fight the markets. It'll tear you in half. So it will sniff out changes coming down the pipe. And you just have to kind of keep your head on a swivel for those.
Great. If the audience has any questions, please feel free to pop them in the chat box and, we'll definitely address them online. Sean, what are we currently in now?
Like I said, almost no equities and haven't been for a while. We have the only U.S. equity sector that we do have is consumer staples and Indonesia. Indonesia is pretty simple. Their economic outlook is awesome. Currencies, we have gold, U.S. dollar. Those are two things that love Quad 4, and the signal agrees with it currently. And then from there, a ton of treasuries. Whether you're our most aggressive model, which is like, 60% treasuries, to our most popular moderate model is at 40% treasuries, all across the curve. Short end, long end. I've just been buying them really the last, slowly for the last 6 to 8 weeks. And then it's really ramped up in the last 36, 72 hours once the 10-year yields start crossing over that 1.9 barrier.
All right. We do have a question from the audience. I'm going to go ahead and bring it up. So it says, if the interest rates do rise, how long before it affects our deposit accounts? So
I'm guessing they're talking about the banks. Their savings accounts.
A bank account. Mm-hmm.
Yeah, probably not a while. Like, we're not talking about major interest rate hikes. And the only thing that the Fed is affecting is the Fed funds rate, which is the bank overnight lending rate. So, and we're going from a range of 0 to 0.25, from probably to 0.25 to 0.5 is where I'm guessing they're going to jump up to. So, you might see some follow through with savings accounts months, maybe. It depends on what the bank may want or may not want to do. The pass through may never come. Banks are generally not very great at treating their customers well, if we're honest. Like, they don't care. But I hope that answers your question. If it doesn't, happy to have a follow up.
Where we will see, changes, if the Fed increases rates, as Sean mentioned, is the, banks borrowing from each other, the overnight rate, but also some consumer lending as well. And so this could possibly spill into mortgages, just seeing slightly higher interest rates. So in a way, it'll affect borrowing, the cost of borrowing, and increasing that. So
yeah.
Overall.
But if the 10-year falls off a cliff, then it could mitigate itself. Like, there's not just one,
it's not just one factor.
Yeah. Everyone thinks for some reason that the Fed has this dial that they go to the banks and say, all right, increase your mortgage rate by X. They're not, I can't do that. The banks have to set their own rates. But the Fed can control some things from behind the scenes, and there is some flow through, but people always underestimate the importance of what the 10-year yield is. That is tied into so many things. So just as important is kind of keeping an eye on that. If that falls off a cliff from 1.9 to 0.9, which is probable, but I'll shut up. I'm rambling.
Well, I don't see any other questions popping up. Sean, do you have anything else to add? In regards to the newsletter, anything for our portfolios?
Yeah. Turn off your financial media. You're going to hear so many wild theories out there of what's causing X or Y. And I would say maybe 2% of the time I see an argument that's sent to me by somebody. I'm like, that's valid. Most of the time it's the dumbest stuff in the world. Apple broke its 30-day moving average, time to sell. It's like, oh God, who does this crap? People do it. It's dumb. It doesn't work. Moving averages do not work. And you back test it. It doesn't work. The gold bugs are going to probably come out. I'm a fan of gold right now. We have a lot of gold. All of our models have it around 10%. Yeah. Alpha's gold levered up. I mean, gold does do well in these environments. So I would just be very careful on what you hear out there. 40 to 60 towards Treasury.
We have another question from the audience.
Yeah, all the way across the curve. Twos, 10s. We still have, and lately we've been adding to some, 20s and 30s because they just crossed over 2.25. So we're
So real quick, Sean, before you answer, I just want to read the question out loud so everybody knows what it is.
Yeah, sorry.
So we received a question from the audience, and it says, with 40 to 60% allocated to treasuries, are those weighted towards short or near term or long term?
We have exposure all across the curve. We were quite even coming until the last, like I said, 3 or 4 days when we got pretty long on the long end of the curve. There's still some room for us to expand on the long end of the curve. There's a CPI report coming out that I have my eyes on that could be more of a buying or a selling opportunity. But the short answer is the whole damn thing. And we've been getting heavier on the longer end lately just because it's been ripping up. Now today it's come back some. If it comes down again the next few days, I might sell a little. We know in the next few months, the yield, no, let me take that word back. I don't know for damn sure anything that's going to happen for sure in the future. It is extremely probable, yields are going to fall off a cliff. I'm just trying to position our models as best as I can, get the best prices in as I can. I hope that answers your question, Brant. But if it did not, happy to take this offline, but all over that curve, short, mid, long, all over the place, but beefing up on the long end lately.
So also, I just wanted to clarify, part of Sean's process right now is that we're slowly fading into treasuries before everyone starts to run towards them. Because that's when we don't want to get in, as much we want to slowly fade in. And when everyone's, running for the door.
Consensus is short treasuries right now, which is insane. CFTC futures and options, you can, on a weekly basis, you can kind of see what the hedge fund community is positioned as, and, the net short treasuries right now. People are long the S&P and short treasuries right now. Well, at least a lot of the buy-siders. What the buy-siders is hedge funds. And it's when they rush to us is about the time we want to start exiting stage left. Get there first. Again, this feels a lot. If I was going to time frame this, it feels a lot like, late 2018. We sat in treasuries are really pretty boring.
So long.
We sat there for, 5-6 weeks. Nothing's really going on. And then all of a sudden yields get cut in half and you're like, whoa, what the hell just happened? And then that's when you start fading out of them.
So yeah, get there early and leave early.
Yes. Yeah. Never, if everyone's standing next to you in a burning house, time to go. All right. Oh, yeah. Look at CFTC futures and options is very insightful of how the street is positioning of what they think is coming down the pipe, and it's usually it's helpful. It helps you kind of make sure you're not in that burning house with everybody.
Great. So we do not want to be in the burning house. Yes.
It's not good for your health or your portfolio.
Yep. Well, if there are no other questions, I think we'll wrap up for this session. And you will, and anybody attending this webinar will receive a recording afterwards. We'll also post this webinar to our nestfinancial.net website. If you know of anyone who's interested.
And YouTube, as we discovered before this.
Yes. Yep. Their home is on YouTube as well. Yeah. So if you know of anybody who is interested in having their portfolio reviewed or having any investment questions in general, we would love to schedule a one-on-one and have a chat, see how we can help. So until our next webinar, which will be next month in March, mid-March, if you have any questions, please feel free to reach out. All right, Sean, I'll see you later. See you later, everyone. Take care.